Gold takes center stage on September 3, 2023. No game with gold. As you may be aware, I have been emphasizing for months now that an incredible pressure is mounting in the gold and silver markets through derivative instruments, leading to price manipulation and downward pressure. How is this happening? It involves borrowing a certain amount and then replicating it with derivative instruments. However, this week, a significant data point was released. The cost of borrowing gold during idle periods surged abnormally. Typically, when gold experiences such price hikes, it tends to reach its bottom. On the other hand, the United States, through the Federal Reserve, Fed, has been evaluating the global dollar via the DXY index for quite some time. This allows them to control the entire commodity market and attempt to contain inflation. Let's see how this unfolds. Assessment of current agenda and markets. The global dollar index, as you know, includes currencies such as the euro, pound, Japanese yen, and Swiss franc. Evaluating the DXY against these currencies may not hold the same significance it once did since it mainly encompasses G7 countries, meaning Western nations. As the world shifts towards a bipolar economic structure, the importance of the DXY is gradually diminishing. The long-standing inverse correlation of over 90% between the DXY and gold may experience disruptions. What I mean to say is that for some time now, the perception has been that a strong dollar is imminent, giving the impression that the entire commodity market will be subdued. However, the Western financial system's final moves in this game might be approaching. According to data released this week, gold borrowing costs have reached levels last seen when gold hit its bottom in September. When borrowing costs rise significantly, no one wants to short gold at this price or lend their gold because it is believed that the price will continue to rise. Consequently, borrowing costs are on the rise, and during such periods, prices tend to surge even higher. Therefore, there is a high probability that gold may have already hit its bottom in its recent movements below $1,900. Starting from this week, we will closely monitor these developments, as we discussed in recent weeks. Leading indicators have shown that silver led the way up, and the gold-silver ratio shifted its stance. However, there was a slight slowdown towards the end of last week. Especially at the beginning of the Labor Day holiday next Monday, we will closely watch for any potential retracements. On the other hand, central banks continue to buy gold. Singapore's central bank purchased an additional 2 tons of gold in July, increasing their reserves to 227 tons. Eastern countries are still accumulating physical gold reserves. However, I've received questions from some close followers about the economic issues in China and whether there is a possibility of them selling gold. While such possibilities exist, it's worth noting that the issues in China have been a controlled and conscious downsizing operation for a long time. Therefore, I believe gold purchases will continue, and I still don't think they will turn to selling gold. With that, I hope I've answered that question. Looking at the gold price. If we look at the charts, last week we encountered a resistance level at $1,940 in gold. We briefly surpassed that level and saw $1,952 on Friday, but we closed below it. So, that resistance level at $1,948 still holds significance. Our short-term tracking level is between $1,948 and $1,933, and our daily portal is between $1,982 and 200 days. These levels are essential, especially for those who play the numbers. If you're a long-term trader, I won't be sharing the long-term chart this week, as you know. I have significant gradual targets for the medium and long term, with $3,600 being one of them. We expect to see it surpass the historical peak at some point this year, as I've mentioned before. Analyzing silver. The charts I provided worked perfectly. The last resistance level we mentioned was $24.80, and we slightly surpassed that. However, we experienced a slight pullback, and I didn't like the last candlestick pattern on the daily chart. But our trend followers came very close to $24.04. As long as we stay above that level, there's no problem. We may continue to linger within this triangle below $24.04, which could be problematic. There might be some more delay. Our medium-term view remains unchanged, but if we stay below $24.04 for too long, it could signal trouble. For short-term players, sticking to stop-loss levels is crucial, but I don't expect significant changes for medium-term players. Gold-silver ratio. The movement in the gold-silver ratio has been quite interesting. We briefly dropped below 78 but couldn't sustain it and moved higher. Even last week, we went above 80. On the last day of the week, we reached 80.50. There hasn't been any disruption in the trend, as long as we don't see a closing below that level. If we see more closings above, there might be some more delay in the anticipated movements. Lately, we've observed a tightening range on the weekly chart, suggesting a potential breakout. We've been hovering between 80 and 80.50, and as long as we stay in that range, there's no concern. However, staying below 78 would trigger a shift. You know, I have medium-term targets at levels of 30.46 and 30 in the gold-silver ratio. This indicates a bullish outlook for all precious metals. Platinum. We've started liking platinum again, and it has cleanly risen from $900 to $1,000, staying green every day. However, towards the end of the week, it changed direction slightly and retraced to around $965. As long as it stays above $956, there's no problem. If you notice, all precious metals may exhibit some further stretching, but I don't think there will be a significant downside. We'll continue to monitor platinum closely, and while there might be some deeper retracements, I can already say that if it stays below $24.04, there might be some delay in the price movement. So, short-term players should adhere to their stop-loss levels, but I don't expect significant changes for medium-term players. Wheat. We're still seeing sharp downward movements in wheat, and it's quite interesting. Wheat prices are being manipulated, and there have been significant retracements down to $569. Last week, we reached $587 by the end of the week. In these types of products, you need to be cautious. You can't just buy continuously thinking it will keep dropping. The price might drop significantly lower, as per this chart. But in the long term, these products tend to regain their premiums during certain periods. Wheat is often discussed in terms of inflation. Next week, there will be a meeting between the Turkish Foreign Minister Hakan Fidan and the Russian Foreign Minister Sergei Lavrov, I believe, which might involve discussions about this grain corridor. We need to see if any news emerges from there. Positive news flow could lead to upward movements, and there might be deeper retracements as well. However, I still don't expect wheat prices to stay significantly lower in the long run. If you're a screen trader, you might need to test your patience. Therefore, it's advisable not to allocate a large portion of your portfolio to these products. Cocoa has been trading sideways for a long time, trapped within a large triangle. From a technical standpoint, it recently broke out of that triangle and made a significant move. Now, for patient investors, when you are within such a triangle, short-term horizontal trends can occur, followed by a few attempts at breaking out before catching a major breakout. In terms of the US dollar, we saw a move from $2,192 to $3,670, and I still expect this movement to continue towards $5,200 in the medium term. However, in the short term, as long as it remains above $3,538, the trend will continue. But if it consolidates at any point around here or experiences a correction, I wouldn't be surprised. Such a strong move can sometimes be followed by a correction. Look, in the world of commodities, trading can be like this. Some people expect immediate results in commodities just like they do in stocks, hoping it will take off and soar right away. But in commodities trading, patience is key. I provide trend levels for short, medium, and long terms every week, emphasizing the importance of sitting tight and being patient. Sometimes, you might not be cut out for trading these instruments, and that's perfectly normal. However, if you believe you are suitable for it, it's a good idea to allocate a portion of your portfolio to these products. When I say products, I mean both the commodities market and others, because a healthy portfolio cannot be built on stocks or the forex market alone. You need to diversify your basket to enrich your portfolio, because commodities can sometimes deliver stronger movements than stocks. So, you can feed your portfolio with commodities during times when the stock market is not performing well, just as I see it happening now. Select specific products from within this asset class, as some of them have major rallies from time to time. Currently, we are keeping a close eye on gold, silver, and platinum, as we anticipate movements in these commodities. Wheat, on the other hand, is weak at the moment, but we are still monitoring it patiently. We followed cocoa for 4 to 5 years within that triangle, and we witnessed its breakout step by step. Uranium, a favorite commodity, began its breakout last week. We saw an upward movement, and it went up to $39. Now, as long as our trend-following levels remain above $37.94, I still see the potential for this move to reach $60, $70, or even $77.77 in the medium term. I am not expecting a turnaround just yet, but closing below our trend levels might bring some hesitation, so it's worth keeping an eye on it. This is an excellent opportunity for ETF traders, as there's a clear breakout signal from our trend-following levels. Natural gas is still trading between $2 and $3, and last week it reached up to $2.90 before a slight pullback. Currently, we are above our trend-following level at $2.69. Unless we close below $2.69, there is a possibility that this move could take us to $3.50. Technically, this setup provides favorable margins for short-term trading, as natural gas has formed a solid trading range. Brent crude oil is a significant commodity that we have been monitoring for months. It had formed a sideways range and recently created a well-defined cup and handle pattern. After breaking above $87.76, especially on Friday, the breakout was quite strong. However, our trend-following level is at $85.91, and a sustained move above this level could potentially lead to a move towards $103.76. From a technical perspective, Brent crude oil looks promising, and with global supply constraints still in place, it might offer trading opportunities in the coming week. However, abrupt pullbacks can happen at any time, so please do not trade oil without setting stops and avoid using excessive leverage, as it is a highly volatile instrument. Euro/dollar is an important instrument, and it recently fell below 1.0808, which is below the 200-day moving average. This is significant as it has been a long time since it traded below this level. Sustained trading below 1.0808 could lead to a significant downside move. Stagflation is becoming a concern as inflation remains high, and the European economy appears to be slowing down significantly. This could put pressure on the euro, and if it does not rebound above 1.0808 soon, it may signal further weakness. Pound/dollar appears to be following a similar downward bias, and it has formed a potential head and shoulders pattern. This pattern has the potential for significant downside targets, with 1.2746 being a key level. As long as our medium-term trend-following level remains below this point, the bearish bias is likely to persist. Euro/yen, which used to be highly correlated with equity indices like the S&P 500, seems to have lost that correlation lately. While Euro/yen used to move down when S&P moved down and vice versa, this relationship is not as clear now. Looking at the Euro's chart, I see some weaknesses, suggesting that Europe is struggling with a significant economic slowdown, possibly leading to stagflation. Therefore, it might be prudent to consider short positions for Euro/yen trading. In conclusion, I want to emphasize that the global dominance of the US dollar is not going to disappear overnight. Such predictions should not be made. However, we are in the early stages of a cycle where the dollar's supremacy is being challenged, and it is starting to lose some of its strength. We will continue to monitor these developments. In these challenging times, I will strive to keep you on the right track and help you navigate through the uncertainties. Be cautious, and may you have profitable days ahead.